The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we wrapped up the week of trade on Friday, a holiday-shortened week, and we saw plenty of downside pressure throughout the grain and oilseed trade. Livestock, too, a little bit of moderate pressure to the downside there as well. We're going to dive in and discuss. Here to join us and talk about it, our good friend Ted Seifried with Zaner Ag Hedge is on the show today. Ted, it is good to catch up with you, buddy. How you doing?
I'm doing well, Jesse. Thanks for having me, man.
I appreciate the time as always. We have plenty to take a look at here on the show today. And you and I were chatting before we jumped on the air a little bit. Kind of a rough day, especially wheat, downside leader there, corn, beans, rough day, especially corn the last couple of days of the week. So as we kind of just take a 1,000-foot view here, I know the dollar was higher Friday. Obviously, have to think that created a bit of a headwind, and some of the outside market worry maybe also created a headwind on Friday. What do you think?
Yeah, outside markets were a little bit mixed, Jesse, because crude oil was higher. So that helps a little bit when you talk about ethanol and you talk about biodiesel. But aside from that, yes, that dollar up over 600 points, the Dow down over 400 points. So, that combination of lower stocks, higher dollar does create that sort of risk-off trade for a lot of commodities that don't have some individual fundamental moving them like, say, crude oil did. As far as the grains are concerned, yeah, I don't know if this is it, right? Jesse, you and I have talked about for months how there is this tremendous downside risk that we have in these grain markets because we have been trading at the higher end of the historical range for quite some time, going on 2.5 years, really. And you knew at some point the whole adage of high prices are the cure for high prices, i.e. demand destruction, i.e. we're going to produce more. And you knew all that was coming. It's just a question of when. And I don't know if this is it or not. If it's not, this is definitely a very strong foreshadowing of what may be to come further on down the road. Keep in mind, we do still have a growing season to get through here in the U.S. And, that second season Brazilian corn crop still has a growing season to get through. So it might be a little bit too early to take away all of the weather premium here in these markets. But the writing is kind of on the wall. Mm-hmm. We haven't created a new paradigm. We haven't put in a new plateau of $5 or $5.50 corn. That hasn't happened. Maybe the paradigm has shifted a little bit higher because of the inflation, but it hasn't shifted to, say, $5. So there is downside risk here. And so what we saw Thursday and Friday was a very sharp reminder that is the case. And, that's kind of a good thing for these markets. For corn in particular, it's been trading so sideways for so long that a lot of producers have gotten very complacent, just basically saying, you know what, corn's not going up, it's not going down. I'm happy with the prices, very happy with the prices that we have here. Love to see higher, might as well wait and see if that happens. We got a growing season, seasonality. We usually hit our highs in June or July. It's really fostered the whole concept of complacency, the whole feeling of complacency. And maybe Thursday and Friday were a bit of a wake-up call there. And that's good because I think guys needed that. We have to realize that we paid a lot for input costs. They've come down. But, a lot of us booked in the fall when they were really at their highs. This is the highest risk corn crop that any of us have ever planted, right? So you can't be complacent when prices are up at these levels. You have good profit margins right now. Most of us should, anyways. You gotta take care of that side of the equation too, Jesse. And again, I think Thursday and Friday really serve as a reminder of that. Now, whether this is a big flush out or not, markets have a tendency to overcorrect, right? And you worry that maybe we were trading at or above fair value for a while. At some point, we'll go below fair value. That's the worry. I hope this isn't the time for that. Again, we still have 2 crops to get through between the Seifried crop and our crop. But you look at the demand side of the equation, and that really is the problem. Every single portion of the demand side of the equation is lower or hasn't grown as much as you would like it to year over year, because we are seeing that demand destruction occurring. And exports being the big one, the one that we really get concerned about. And there Friday morning, we saw export sales again, and they were very lackluster for corn once again. Soybeans continue to kind of surprise in a time frame where they should really be falling off, and they're certainly lower than they were a couple weeks ago, but they're still there for that matter. But the corn export sales are a problem, right? Even with Argentina, major issues in Argentina, global end users have not been motivated. They don't have a sense of urgency to come in and aggressively buy U.S. corn. And that is a big problem. And I think that's a big part of why we were down Thursday and Friday. And then I would also say the ag outlook numbers, even though we don't generally put a whole lot of stock on those, because it's really just a very first glance at a USDA balance sheet. It's not even a balance sheet on a WASDE yet, but it sets their trend line yield, a 181.5 for corn. That seems lofty to me. And I also would say roughly a 1.9 billion bushel carryover for next year corn may be lofty for me. Yeah. But I think the trade really kind of took a step back from, and what was a bit of a wake-up call was to see what they did with demand and the lack thereof. And I think that's something that really resonated. And actually seeing that on paper, albeit an outlook forum, I think that really kind of shook the market a bit. And then you had a technical breakdown, right? So you started running some stops, got into areas that we hadn't seen for quite a while. You knew there were stops down there. So yeah, it was kind of a wake-up call Thursday and Friday.
Well, and it felt like, especially in the case of the wheat market, we hit some of those stops and just kind of the continued selling seen there on Friday from what we saw Thursday. And on that thought, Ted, how much credence do you give to maybe the wheat markets being the leader in grains, maybe kind of pulling on corn, beans, either to the downside, to the upside, et cetera? Do you think wheat is more of a leader right now or not?
Well, wheat has been in a very significant downtrend for a long period of time, while corn has been sideways to slightly higher, and beans have actually had a bit of an uptrend. So wheat hasn't really been that leader yet. But this sort of failure to put in a low, there was a whole lot of people that were talking about a head and shoulders bottom in wheat. There were a lot of buyers that came in that put stops under that shoulder that really got run through there on Friday. Now wheat's gotten back down to what I would consider more realistic prices. I think for a while we carried a conflict premium in there, but we never really did see that big pickup in our exports anyways. I think wheat is now getting into the prices where if it continues to go lower, it will be a bigger and bigger drag on corn. For soybeans are kind of doing a different thing right now because our export sales stay fairly good because of the issues in Argentina and the strength in soybean meal. Because look, Argentina, that's not a soybean problem. I mean, it's a soybean problem for them, obviously, but they don't really export soybeans. They export soybean meal. So that means our soybean meal becomes more attractive on the global market, which means crush margins could really increase. It doesn't necessarily mean flat price soybeans have to go sharply higher. That's a much deeper conversation, I suppose. But we could take more of a leadership role going forward and drag on the corn now that it's a much more relative price to corn. But as far as the soybeans are concerned, they're kind of doing their own thing, Jesse.
I want to commitment to traders report data. We haven't seen that for weeks. I've been looking on Friday. Are we going to get some of that Friday, or are they holding off another week, Ted? Do we know yet?
What we do know is that if we do get it on Friday, it's going to be 3 weeks. It's going to be where we were 3 weeks ago. It's not going to be current data. At least that's not what I was reading. So, I mean, I guess that's better than nothing. But it really doesn't get us caught up to speed, and that's something that we're missing. I know that a lot of people really watch that very closely. For me, it's one of my tools in my tool shed. I mean, I do pay attention. I do like it. I do watch it. But, life has kind of gone on in the last 3 weeks. We're sort of doing our thing, and you can kind of get a general sense of how the funds are trading. Sometimes we get these commitment to trader reports and we're surprised because we see market moves and we figure, oh, wow, the funds are doing this. and then they actually weren't. That could be the case. But go back to Thursday in corn, big down day, down almost 15 cents. It was the highest volume day in corn that we had since 2018. It'd be almost impossible to do that without a rather sizable fund participation on that day. So, almost doesn't really matter what had happened leading up to Thursday because, again, corn had been so very, very sideways in that time frame that we've not had commitment of traders. But then what happened on Thursday, well, that's the one we want to see. And that wouldn't happen to next Friday anyways. Who knows when that or if will ever happen. But you have to know from the volume and the changing open interest that there was some pretty hefty fund participation there Thursday into Friday.
We are having a conversation today with Ted Seifried of Zaner Ag Hedge, talking markets, wrapping up the week of trade. Ted, overall, just to kind of put a bow on the grains for us here today, you mentioned some of the downside risk you feel is in this market. So as producers are getting ready here, gearing up, spring planting, few weeks away, even though a lot of areas got hit with plenty of snow and ice here this past week. What do we need to think about risk management wise if we've already done a little bit of, business, old crop, new crop, or we haven't done any at all? What do we need to think about here risk management wise right now?
Yeah, again, I mean, my message right now, Jesse, is just don't be complacent. And hopefully what happened at the end of this week really kind of was a bit of a wake-up call for people. It's not like we're at the lower end of the range, $3.30 corn and $9 beans, where you can just kind of let that go, right? You don't have a significant amount of downside risk. Right now, you have a significant amount of downside risk. Just historically speaking, this is the higher end of the range. We could drop $2 in corn. We could drop $4 in beans. I'm not saying we will, Jesse, but that risk is there. And is there a lot more so this year than it was last year or the year before. And not only that, we've paid a lot, especially for this corn crop. We've paid a lot to do this. But even for soybeans, rent's coming up, interest rates coming up on our loans, so many things are getting more expensive. We just can't sit here and risk the amount of downside potential that these markets had in order to try to capture what I would think is some fairly limited upside potential at this point. We don't have this strong flow of inflation. Yeah, okay, inflation came out stronger than expected in the month of January, but it's nowhere near the levels it was at a year ago. And it's not being created like it was the year before that even. So it's a different climate. We're still at these high prices, which for grains you got to be somewhat thankful for. I mean, look at crude oil, Jesse. It's half of where it was from its highs. Look at natural gas. It's not even a quarter of where it was from its highs. Look at lumber. Look at copper. Look at really all the different commodities, except for the agricultural sector. We know it can happen. We know that when the climate changes and the individual fundamentals change, things can come down in a hurry and really shock people how low they can go, because we had gotten used to this mindset of, corn's going to trade between, 660 and 680 old crop and between 590 and $6 new crop and stay there forever. Well, again, then things change and then they shock people. So, look, don't get shocked, right? I mean, just be active and look, and if it doesn't happen, if you go in and you create a synthetic put by selling cash and owning calls, or you just buy some puts, or even if you just outright flat price cash, it's really not the worst thing in the world, even if markets do go a bit higher on a weather problem. But that's what it would take, Jesse. It would take a really major weather problem for our U.S. growing season to really get these markets inspired again, because we just went through a long period of time talking about how terrible Argentina was, yet we just couldn't make a new high in corn. Beans did okay because we continue to see that export sales number roll along, and we do have a fairly tight old crop balance sheet. Beans are the one thing that we didn't really talk a whole lot about, Jesse, and beans are the one thing that I do feel like you are allowed to be a bit bullish on for the moment, but looking out at a new crop, looking out beyond that, you have to be really worried about what sort of downside potential we have, because when you spend a lot of time at the high end of the range and you kill off that demand, remember 2012, it takes multiple years to go back and find that demand back and to slow production down. So again, the good times are now. the bad times at some point will be coming again, and we need to prepare for that.
To your point on beans as well, it feels like meal has kind of been the driver. We're holding up near these highs, and maybe we're going to hold there for a little bit just because of the Argentina news as we watch harvest in Brazil slow and then the dryness in Argentina. But once that story finally fades, what happens to the meal market? And does that take the sales out of soybeans, I wonder, Ted?
Yes. Loss of soybean production in Argentina does take a chunk out of global meal exports, right? So that means that we could see more business for us. But, don't sleep on Brazil. They're a bigger crusher than Argentina is, right? So, if that crop is going to come out near expectations, give or take plus or minus 2 million metric tons or so, which it's looking very much like it is, they're going to have a lot of beans to crush too. They will fill a lot of that gap for that global meal market that is vacated by Argentina. Mm-hmm. So, I mean, it is helpful, but it's not the be-all, end-all for soybeans. The question for soybeans is, can we keep up export sales going forward? This is the time of year that they would fall out. I expect them to do that. But if soybeans export sales continue to go like they did, like what we saw Friday morning, yeah, we got a fairly tight bean balance sheet that is sort of in a price ration, could be in a bit of a price rationing mode as we get into summer months. But right now, I don't feel like we're there. And I don't think the meal situation in Argentina is enough to keep beans going sharply higher from here. I think, if anything, what it will do is it will take crush margins that are already good and make them even better to try to encourage more production coming from crushers. I think, not to go off on too much of a tangent, Jesse, but for years I've been saying we need to really do whatever we can to increase the crush capacity here in this country, because we need to make the value add. Brazil is going to continue to grow their soybean crop. We need to take on Argentina. We need to take on the meal market, not so much the soybean market. And, back when the trade war started, I'm not very into government interference in the markets. But when the trade war started, that was government interfering in markets. So I feel like it's okay to do the equal and opposite of something like that. I wanted to do tax incentives for crushers in order to sort of bolster that crush margin to generate that extended crush capacity. But then we had the market kind of take that ball and run with it by offering really very good crush margins for a very long period of time. That's increased that capacity. There's more facilities opening. Some estimates are by 2029, we will have added about 700 million bushels worth of crush capacity. That's a big chunk. That's great. I think it needs to be more. And, maybe that's what this will do is, again, the shortness of meal coming out of Argentina should really make the crush margins better, which means meal prices can stay high. Doesn't necessarily mean soybean prices can have to stay high. Bean prices, the input to the crush can come down. Mm-hmm. And that's how you can make those crush margins better. And that could help, spur that further push towards capacity. Again, I didn't want to go off on a big tangent there. Sorry. My point is, the takeaway from that is that the meal situation in Argentina doesn't necessarily mean that our soybean prices have to go sharply higher. Mm-hmm. The crush margins might take care of that for us.
No, I appreciate the insight. I'm glad you brought that up, Ted. We got to talk livestock real quick before we run out of time. Cattle, hogs, fairly quiet day Friday. I know export sales of pork were pretty robust on Friday. Meantime, cattle, I know we got the BSE case in Brazil. That seemed to impact trade Thursday a little bit, but then by Friday, we kind of let the news go, it seemed like. And then cattle on feed report seemed like just some squaring up ahead of that report after the close on Friday.
Yeah, as we always do. And not surprising that we were a little bit quiet in front of the cattle on feed report. That cattle on feed report, very widely expected to be bullish. Reflecting the overall bullish sort of supply scenario that we have in cattle. Because not only do we have lower number of animals, and we know that that's going to be the case pretty much through this calendar year, at least for the first 3 quarters of this calendar year, but we also watched weights drop 6 pounds last week, Jesse. For the first time in a long time, we're below the 5-year average on weights. So low weights, low amount of animals. Wow, that really means low production. So that supply side bull story is there for the cattle. I think we cooled it off a little bit there at the end of the day, Thursday, and a little bit on Friday, based on the idea that the stock market, that dollar higher, stock market down, these talk about these recessionary concerns and things like that. That was a little bit of a wet blanket, but for the most part, we were kind of waiting to see what that cattle and feed report said. As far as hogs are concerned, it's nice to see those export sales there. But at the same time, you don't have the same sort of weight scenario happening for the hogs. You don't have the animal issue happening for the hogs. My hope, Jesse, is that the BSE in Brazil could not only help our cattle or our beef exports. I'm wondering if it's going to help our pork exports too. That's my little bullish tidbit or optimism that I have for the hogs. But you do really feel like hogs found a near-term low. We've bounced off that. We're kind of more towards the middle of the range or establishing maybe a longer-term low. I don't know if I see any reason right now for the hogs to go sharply higher. Maybe the best bet is to maybe tread sideways for a little bit. And I think that would be a relief for some producers.
Ted, always appreciate the insight, my friend. If folks want to reach out to you and get some advice on their marketing there at Zaner Ag Hedge, what's the best way to reach you?
Absolutely, Jesse. You can reach me directly at 312-277-0113. You can also find us on the web at www.zaner.com. You can read a bit about us. You can also sign up for our morning Ag Hedge newsletter. And if Twitter is your thing, I am at the Ted Spread.
Always a pleasure, sir. Have a great one. Thanks so much for the time. Ted Seifried, Zaner Ag Hedge. We'll talk to you again soon, buddy.
Thanks, Jesse. Appreciate it.
That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great weekend.